Hello, and welcome to East Asia Econ. Today we're going to talk about Japan, and specifically the common perception that one of the problems in Japan macro is that companies are being too mean with their workers. And if only companies passed on more of their profits, then the macroeconomy would be okay. We're going to talk about that and suggest reasons why that perception about the economy is wrong, and think about what the implications of that might be, both for the BOJ and also for fiscal policy. Before we get into all of that, just a reminder that at East Asia Econ, we publish macro research about the major economies of East Asia: China, Japan, Korea, and Taiwan. We do a lot of cyclical work focusing on what's happening with the data developments, but also do a lot of structural deep dives, such as the one we're going to discuss today. All of our research can be found at eastasiaecon.com, where you can also see hundreds of charts which are both interactive and updated daily when new data is released. If you're interested in subscribing to our service, please get in touch with me at paul@eastasiaecon.com. And with that, back to the story. So we want to talk about what's happening with both the labour share of profits and also the household share of income. And it's important in Japan, I think, to differentiate between those two things because there's very different trends happening in both. The market tends to focus on the first one, which is what's happening with the distribution of profits. And again, I'm going to argue that the perception of the market around what's happening with the distribution of profits is actually, I think, misinterpreting the reality. The second is surprisingly an area that most of the macro community doesn't really focus on at the moment. That's the household share of GDP. Why is that different from the wage share? Because the household share depends on the redistribution policies of the government. Why does that matter in Japan? Because there's 30% of the population that are now over the age of 65, and so aren't really dependent on wages at all, and are much more dependent on what's happening with pensions, and therefore the government's redistribution policies. So I'm going to talk about these two things today, and then finally go on and talk about what the consequences and the implications of these trends might be. So first of all, looking at what's happening with the wage share of profitability. And to think about that, the kind of quintessential example is what's been happening in the US over the course of the last 20 to 30 years, which is a very clear trend in the labour share of profits falling. So labour is gaining a smaller share of the profitability of companies over time. Now, this is also a perception that's shared in Japan, that this should be what's happening. And the reason for that is because profitability of companies is quite strong. At the same time, there's been zero per capita wage growth in Japan for the course of the last 20 years. So, looks like a very strong case to say that this is because profits are rising and companies are being too mean and passing that money onto their workers. Now, as with all of these things, there is some truth in that. However, it's not nearly as strong as that overall understanding suggests. And actually, if we look at the data, for example, this chart, you can see here that the labour share of profitability, or value added as we call it here, is actually very stable in Japan compared with the situation in the US. Now, as always with data, we need to be careful at what we're looking. And this chart does exclude incomes coming from self-employment and small enterprises. Why does that matter? Because in Japan, that really has collapsed over the course of the last 15 to 20 years. However, when we're just looking at the corporate sector, and that's often what the debate in Japan is at the moment, the labour share of profitability going to labour has been very stable over the course of the last 15 to 20 years. So that seems quite at odds with the perception that actually in Japan, per capita income growth is too low, and that's because of the fault of companies. So what's going on here? Well, clearly per capita wage growth in Japan is very low. Why does that still be consistent with the idea that profitability in companies is strong and companies are paying their workers as big a proportion of their incomes as they has been over the course of the previous few years? The reason for that is because we're seeing a big rise in the participation rate in Japan. So as much as the share of profits going to labour hasn't changed, at the same time, that share of profitability is being distributed among a lot more workers than it was previously because of the increase in the participation rate. And so as the participation rate rises, so per capita wages don't rise as quickly as profitability. And so if we look at overall labour incomes in aggregate, actually there has been pretty decent growth over the course of the last few years. And it's not nearly so negative as when we look at per capita incomes. So that's the first question. Actually, in terms of profitability, it looks like a decent share of money is still going to the labour sector. The second issue is what's happening with the household share of GDP. And that's important again because Japan has this very large proportion of the population who are over the age of 65. And therefore all of this discussion we've had until now about what's happening with wages is really much pretty irrelevant to the incomes that they receive. And actually, if you think about the elderly population, they should really be receiving two types of income. One, in Japan, household sector is still the biggest net saver. So although there's a lot of focus again on what's happened with the corporate sector, that the corporate sector has moved from being a net debtor to a net saver over the course of the last few years. And again, this is another piece of evidence that suggests that companies aren't being generous enough with their workers. Actually, that's only true on a flow basis. On a stock basis, companies still have net liabilities of about 100% of GDP. Households, on the other hand, have net assets of around 300% of GDP. Now, why does this matter? Because obviously over the course of many years in Japan, interest rates have been falling. And therefore you're seeing a distribution of money away from the corporate sector because they're net debtors and so interest rate cuts help them, and away from the household sector because they're net savers, particularly in the form of bank deposits, and so interest rate falls hurts the household sector. So that's one issue when we think about what's happening with household income in Japan, as opposed just to looking at wages. The second issue is thinking about pensions and the tax and redistribution policies of the government generally. And there's also a big change. So over the course of the last few years, the government has been restraining pensions in real terms and actually cutting them in real terms. And also the tax burden of the household sector has continued to rise. Now, of course, in Japan, you might think that's reasonable. The government has very high debt. It would make sense that the government wants to try to control what's happening with spending and also to increase revenue. The problem is in Japan that that's happening at the expense of the household sector. So if we look at what's happening with corporates, the corporate tax rate has been falling over the course of the last few years. Obviously a deliberate decision by the government to do that with the hope that then the economy would start to grow more quickly. And obviously that's part of a global trend of corporate tax rates coming down. However, in Japan, given that you still have this population where 30 to 35% are over the age of 65, the fact that they are more dependent on what's happening with the social welfare policies of the government then does have an impact on the macroeconomy. So what does all of this mean? We're not at all arguing that the state of wage growth in Japan is good for workers or that it's good for the economy. Again, per capita wage growth in Japan is very low. That's a problem, particularly when inflation is rising, and means that we've seen this collapse in real income growth for workers over the course of the last 2 to 3 years. However, I think it is important to understand where the wage data is coming from. And in particular, if it's not the case that the labour share of profitability is falling, then it's quite possible that Japan is near an inflection point where per capita wage growth is going to accelerate upwards. The obvious reason for that is because the participation rate in Japan is now very high. That's clear on both for elderly workers and also for female workers who've been entering the workforce over the course of the last 10 years or so. The BOJ assumes that the participation rate can't get much higher than it is now. Now, if that's true, and at the same time the share of profits going to wages is stable, then as the participation rate stops rising, and so there's less of an increase in workers coming into the workforce, that profitability is going to be shared among not so many workers, and therefore per capita wage growth should start to accelerate. So I think it is important to understand what's happening with the wage share of profitability, because it's going to inform how quickly wage growth on a per capita basis can increase in the future. The second consequence is to think about consumption. Now, obviously, consumption in Japan is very weak, and we've had confirmation that of once again over the course of the last couple of weeks with Q3 GDP data showing that consumption's not just as weak as it was back in 2019, but is as weak as it was back in 2013 or 2014. Now, why is consumption weak? Well, consumption is weak because per capita wages aren't going up and are actually falling in real terms. But again, secondly, because 30% of the adult population are pensioners. and pensions in real terms, due to a deliberate government decision, are being cut. So obviously it shouldn't be a big surprise that consumption is so weak, and that is clearly one of the macro consequences of when we think about what's happening with both wage growth and also household income growth in Japan. What's the consequences of this for policy? Well, if we think about the BOJ, I think it's very difficult for the bank to be starting to think that inflation is on a sustainable upwards path if consumption remains not just below 2019 levels, but below 2014 levels. And without consumption, there can't be a recovery in the overall GDP because aggregate demand isn't strong enough. And without that, how can the BOJ be thinking that inflation is on a sustainable path going forward? At the same time, one of the reasons why consumption growth and income growth is weak is because inflation is rising. And inflation is rising because import prices have gone up, and import prices rising is in large part because the yen has been so weak. And obviously the yen being weak is a function of BOJ monetary policy. So what to do about this? Well, I think this means these two things puts the BOJ in a very difficult position and means it can't move policy very much at all. Now, there is a bear case, I think, for Japan, where the yen continues to accelerate beyond 150, in which case I think it would be very difficult for the BOJ not to be moving more quickly in terms of normalizing monetary policy. But I don't think that's where the BOJ will want to be going. Now, I think it is worth mentioning another scenario, which is the more positive one. And that's a scenario in which US rates have peaked, the US dollar starts to come down, and the yen falls back below 140 or thereabouts. At the same time, we see participation rates in Japan peaking out. If in that scenario the economy is still growing and the share of profitability going to labour holds up, we're going to start to probably see quite a big increase in per capita wage growth. So precisely the source of frustration for a lot of people looking at the economy could actually become something that's quite positive over the course of the next couple of years. And that will change the inflation dynamics in Japan on a much more sustainable basis. So I think that's the significance of the thing that we're looking at today. If we understand properly what's happening with the share of profitability that's going to the household sector, then it doesn't look like there is a labour share squeeze in the way that there is in other countries. If the economy continues to grow, but the participation rate stops increasing, we should start to see per capita wage growth really accelerating in Japan, and that will make inflation look much more sustainable than it has until now. Now again, all of this analysis and more can be found at eastasiaecon.com. We publish things most days of the week. These structural things take a bit longer to put together, so they're a bit less frequent, but there's also all of the charts on the website that you can check out. Again, eastasiaecon.com. Thanks very much for listening.